auctions are not the place people think they are. There are a few things you really need to know. You need to have...
I missed something the other day.
It's that dangerous. The way I've made money in auctions is actually...
Welcome back to another episode of the Property by Kazy podcast. Each and every week, we get an amazing property professional to shed some light on their journey, the current market, and to give you some free information. So if you haven't already, make sure you subscribe. But without further ado, let me introduce my guest, Omer Mehmet. How you doing?
I'm really good. Thanks for having me on the podcast.
Appreciate getting you down. I caught him downstairs in the workspace for about an hour. He was here. I was like, "You're right." He's like, 1 minute. Constantly 1 minute. That 1 minute turned to an hour. So you know he's a busy man. So we appreciate you giving us your time today.
Apologies. Yeah, I was trying to do some stuff in the lobby. The internet's not too good down there though. So
it's all right, man. Well, hopefully you got some business done.
Yeah.
So Omar is from Trinity Finance. That is was your primary business.
Yeah.
How long have you been running for?
So I got into property about 15 years ago, but my background was corporate mortgage broking is where I started basically. Trinity is my main mortgage business that was established in 2015. So, but prior to that, mortgage broking for a number of years for a corporate business. So yeah, Trinity is the main one. We're based in Bexley and Welling, so quite well known in the area now.
Yeah, quite well established. But you got 40 staff members,
roughly about 40 staff.
In excess of 40 staff.
Yeah.
So let's talk. I guess before we get into the property space, let's talk numbers, interest rates. How have you found things over the last year?
To be honest with you, the mortgage business over the years has changed quite a lot. I mean, there's regulation is just ever increasing in our space. We're a bit of a specialist lender, so we a specialist mortgage brokerage, if you like. We do resi, buy-to-let development, bridging, you name it, we do it, and we've become quite well known for auction finance because of my kind of background in spending a lot of time studying auctions. So we naturally get a lot of our clients that want to buy and sell through auctions, and that's become our real speciality. But COVID, you know, we've gone from interest rate environment of next to zero, where everybody, you know, could have borrowed money at 1.5% and fixed their mortgages at 10 years. But hindsight is a wonderful thing. So then all of a sudden, you know, interest rates going up to 5.25% base rate now. Yeah. The average buy to let 5.5%. At one point, that was nearly 7%.
Yeah.
So it's calmed down a little bit. Swap rates, which are the biggest indicators of how mortgages are priced by lenders, they've kind of dropped down a little bit now. We're back at sort of 3.5%, 3.7% on the swap, 5-year swap that is. And essentially that means mortgages they're becoming more affordable, but they're not as they used to be. Yeah. So it's a challenging one because from a mortgage perspective, I've got lots of mortgage brokers that are hungry to do business. There's 27 odd mortgage brokers. They're all looking to do business. And when interest rates are steady, our jobs are very easy. But when interest rates are climbing or falling, we find we have to do a lot more work. Yeah. So, you know, imagine now you're after a mortgage, Kaz, and you see the interest rates have dropped, but you've already got a mortgage. You're going to ask for it to be changed, aren't you? So we do one mortgage and we end up keying the same application 3-4 times for people. So it's a lot more work for us.
I see that as a developer on the other side of things. That we're selling. We've got like our exchange date, day before the exchange. There's, you know,
they're delaying it.
Delaying it. Rates have dropped. New survey pushing things back. So I think across the board, it does tend to stretch out the buying and selling process. Yeah, and
the lenders don't pay us any more than they've paid for decades. We're still on the same sort of commission that we used to be on. So it's kind of doing the best you can in this environment, I suppose. So
I guess the upside for yourself and for other brokers is that when there's movement in the market, people are more likely to potentially move who they're traditional. If you just got a go-to person, it's really straightforward. Whereas when rates are either increasing or decreasing, you're more likely to potentially shop around or look to speak to somebody.
I'll give you some facts then. So there are about 30,000 mortgage brokers in the UK. That's kind of across financial advisors that do some mortgages as well, but mainly mortgage brokers. And of those individuals, the majority of them specialise in residential and simple buy-to-let applications. And my belief is that over the next couple of decades, those types of mortgage brokers will pretty much be wiped out. You've got the likes of robo-advice, of these businesses like Habito, Trussell, even London and Country, some really big mortgage brokerages that are systemising that process of obtaining a mortgage via AI and all this intelligent stuff, right? Beyond me, even though I'm relatively young, I'm a little bit old school and haven't kind of gone down that path yet. But where it becomes interesting for me and my business is when there's specialist lending involved. So if someone wants to do SPV and they want to buy a block of free flats, or they want to do HMO, sui generis HMO, or knock down and rebuild, anything complicated, computer says no. Okay. And you need human intervention. So the face-to-face model of mortgage broking, I don't believe is going to disappear. I just believe the need for it will be a lot more specialist. So commercial lending, bridging, development, second charge, mezzanine finance, all this stuff, I don't think computers will be able to take over.
Because there's too many intricacies and too many little details that would sort of
absolutely
bottleneck a streamlined
and like
process.
you probably, when you're doing this type of application, you having someone there who knows what they're doing that guides you through it is invaluable. So
like even just from an understanding of what product fits what purpose. And I'll give you an example of something I'm buying at the moment. We spoke off camera about doing a lot of 1 to 2 bedroom conversions. Now there's specific products that require consent, freeholder consent. Now the actual terminology in a lease is any fixtures and fittings that are moving requires consent. Like taking out the bathroom, kitchens, etc. The reality of getting that consent granted from, for example, an auction purchase is no, because the freeholder wouldn't have even interacted with you. So being able to speak to a broker that understands fit for purpose and then making sure the product matches that, I think is invaluable.
100%. And I think that's the key thing, isn't it? Is knowing the person you're speaking to. If you're just speaking to someone that's just pushing up buttons, it's very difficult. A lot of the best mortgage brokers, and there are hundreds of them, they specialize in that particular field. So I find I still do mortgage business, although I'm heavily into property now. I find the majority of the people that I like working with are doing stuff in the auction space, because we're kind of going through a journey together of I'm buying and selling stuff. They're coming to me and buying stuff at auction. And sometimes they miss things and I point it out to them and they don't realize. And vice versa. It's just, if you enjoy something, you like arranging finance for that particular sector as well. So it works really well. But mortgage business is good. For me, it's always been, the businesses I've built have kind of been built around each other. So it's a synergy business for my other businesses. Having a real good concept and grasp on the mortgage market lets me quite easily know when I'm transacting with property, is that going to work on a refinance, on an exit? Is my buyer going to be able to get a mortgage?
That's the thing, I think, as developers, particularly if we're looking to refinance or even looking to sell, a lot of the time we're very much subject to valuers' comments and understanding what that's really going to look like, and potentially being able to get a product either where you've got maybe an indicative pre-agreed valuation of the back end, can be invaluable. How has the change in rates affected bridging? Bearing in mind there's a degree of private money. Have you seen what level of prices increased? Or
do you know, bridging hasn't really changed that much. It's very strange, actually. I mean, it definitely creeped up a little bit, but because there are different ways that banks get money. You've got the kind of deposit takers, the mainstream banks who essentially get money from people that want return on their savings, and they get that and they add a little margin, they lend it out to someone. So they're not as influenced as quickly by the swap rates, the money markets. But the majority of bridging providers, there are some that have their own private funds or funding lines, but a lot of these bridging providers, they are directly going to the swap rates and they're borrowing money from the markets and then lending it out. And what we found since kind of the interest rates changed was a long time ago with bridging, or a couple of years ago, essentially, if you went to some of the normal bridging providers, I won't name them, but they would typically say,
they're not paying for this,
so we're not naming them. If they want to come and sponsor the Property by Kazy podcast, then we can start dropping some names. But typically they would want, 1% a month or 0.8% per month, but that would actually be fixed. If you read the terms and conditions, it would be fixed. Now what's happened is, if you read the terms and conditions, a lot of the bridging is floating, or it's tracking the swap rates, or it's tracking the base rate, it's tracking some way. So what the lender's doing is they're mitigating their risk, saying, if the swaps go up even more and our margin gets squeezed, we're not taking that. You're going to take that hit. So you'll see a lot of that in the bridging terms and conditions.
I guess that's it. It's not necessarily got that much more expensive. However, you're exposed to more risk effectively for the luxury of not paying more. I'm sure there are products where you don't have that, but you'd have a much higher
a little bit. I mean, the bridging rates have definitely gone up a little bit. I mean, go back 4 or 5 years ago, I did some bridging loans for people at 6%. really cheap bridging loans with little arrangement fees and very little exit fees.
And what sort of loan to value were they at?
They're 60% loan to value,
60%,
56%. So you would get it at that level. But now, there's a couple of providers at 85% loan to value if you're doing works to the property and increasing the value, and you give them a schedule of works and that sort of stuff. Now you are looking at interest rates that are kind of more like 0.85, 0.9% per month. I'm sure you're used to that sort of borrowing.
That's the sort of rate they're kind of used
to. But still fairly attractive, isn't it?
It's still fairly attractive, and that's why I'm often sometimes confused when you get these people like, oh, I'm going to use a buy-to-let mortgage, for something that's not fit for purpose.
Yeah.
When actually, if rates are about 5.5%, and then you've got an arrangement fee and an early redemption penalty, you end up looking at about 9%. Where
sometimes
you could just
more.
Bridge it, and sometimes it's actually cheaper to bridge, and your fit for purpose product as well.
We're going down a proper mortgage hole at the moment, but I can talk about this.
Don't worry. By the way, there's some extra sexy stuff coming. There's HMO conversions. There's auction arbitrage. There's auction purchases in general. There's just loads of great property stuff. So don't worry, that's coming for you real soon.
Stay tuned if you're bored of the mortgage chat.
But it's money at the end of it, and it can sometimes boring is where the money is.
So I get that. It's one of the most common things that comes up is people will come and they'll say, I want to buy this property. Oh, bridging's so expensive. Can you just get it on a buy to let? Well, one, you're breaking the terms and conditions of your mortgage. You're not allowed to take this property and do a 4-meter extension at the back and convert it into a 6-bed HMO. You can't do that. But people do try and do it. And then they don't realize that because of the stress testing, the difference in getting a 2-year fix or a 5-year fix, you end up having to get a 5-year fix because you can't borrow what you want on the 2-year fix. The 5-year fix has got a 5% early repayment charge. So you think about it now, 5.5% interest, 5% exit fee, that's 10.5. You paid 2% arrangement fee to set the mortgage up, you're at 12.5%. Should have just taken bridging.
And that's what I try and explain to people a lot of the time, but it's people just hear the scary number, hear one, and I get it. If you're new, 1% a month, for example, sounds super scary because then you start to think 1% a month, even with retained interest, do 9 months retained on a 12-month bridge. I think, well, if I go over, all of a sudden I've got £4,000 or £5,000 to pay a month. But the reality is that's where you've got to make sure you get your deal tight. You've got to understand how long it's actually going to take you to exit. Have your retained funds if you need them, if you don't want to be stressed, or just retain the whole amount.
Reading the terms and conditions. There's some bridging providers, again, who will not be named on this podcast, but they, if you read the small print, they don't highlight this stuff, but if you go 1 day over your term, they'll slap a 5% early repayment charge onto your debt. So, and then there are others who are very amenable, and you come to them, you say, look, I need another month, and they'll charge you 2% in that month to give you a bit more time.
And I think that's the importance of having, regardless of who you're using, having a good broker who understands fit for purpose. So if they know, you're an established developer and doing this for years, they understand, look, you're going to get this in and out in 6 months. So your 12-month term is fine. If maybe you've got a planning issue, some other things, and you need to understand that what's that lender like if you need to extend? What are the penalties like? Because there are some that can be very ruthless and there are some that can be very amenable. It's understanding, and obviously you be in a position to recommend to clients, potential developers, actually, they may be an extra 0.5% more expensive, but that extra 0.5 could save you 5% off the back end.
You can sleep at night.
Exactly. But we're done. We're gonna wrap up our conversation around this. Is our personal conversation around all things. So obviously you've then transitioned into property. You've been very heavily involved in auctions. What's that look like for you?
Do you know what? When I first started in trying to get my first properties, I used to work in lots of estate agents because because as a mortgage broker prior to 2015, I worked for a couple of corporate businesses that have estate agency brands, and I would work in their estate agents a lot around the Kent and South East London. So I've probably worked in 40 different estate agents over about a 6-year period, and got to know the different areas and got to see all the dodgy dealings of these estate agents over this time. But what I sort of realized is that there are deals in estate agent. I've made some good money out of buying properties for estate agents, but the standard conveyancing process, the standard house buying process for certainly for some people that want to transact and want to do volume, there are lots of reasons why things will fall out of bed.
Yeah.
And sometimes it's even out of your own control. Unregistered properties, probate not being granted, the estate agent disappears, or, you know, just the things happen constantly.
Literally,
to me.
this week I had bought on right to buy.
Yeah.
Gone over the 5 years, but hadn't checked to offer them right of first refusal.
There you go, yeah.
And it's just like, you've already paid £600 for a survey by the time you realise that actually they can't even sell the property in the first place.
And you paid legals and you're invested in your time. So the first property I bought at auction, it wasn't any other reason other than I saw it on the internet and thought, this looks like a deal. And I had a skill set to be able to solve some problems with the property. And to be honest with you, I got addicted with it to auctions from then. I mean, if you go back a much longer period of time in my life, when I was 18, I bought my first car from an auction, actually, from British Car Auctions, the largest car auction supplier in the UK. And they sell about 3,000 cars a day, roughly. So I bought my first little clapped out Ford Fiesta R-Reg for about £1,000 from auction.
R-Reg is good, man. You know, my first,
doing all right,
my first one was an F-Reg Nissan Micra.
Yeah.
Boy, on the, from the loot.
Oh, right, okay,
from the loot.
So I was one step up.
Exactly.
Kaz, So I bought this car and I bought it back, and then looking on Auto Trader thinking, bloody hell, I could sell this car for 500 quid more than I've just bought it for. You know, all I've got to do is T-cut that little bit there, put a new hubcap on, and Bob's your uncle. So, and I basically did that, went and bought another one, bought another one, and I sort of 15 odd cars of trading cars at auction. I ended up having a nice little Mercedes paid for from my activity at auction. So that was my first kind of dabble with the auction space. Got burnt a couple of them transactions, but overall they were pretty good. And just moved into doing it in property. So taking rundown properties with problems, with cracks, with knotweed.
Give me an example of some of the problems. I think that's
so the first one I ever bought was in St Mary's Cray. And it was sold at Clive Empson auction, and when it was sold by a housing association, and at the back of the property there was quite a large crack, and just on the back elevation, not on the side. And I'd gone to the viewings. I've taken my dad, who's a builder for the last 30 odd years, so I got a bit of an advantage there. And when I'm at the back of the property, I'm seeing all the other people viewing who are saying, oh, you know, look at this crack, the house is going to fall down, it's subsiding. And not the novice investors, but they were, I suppose, less knowledgeable with construction. And me and Dad quite quickly worked out that this was just a cracked lintel and just needed a set of patio doors changing and a lintel. We planned to extend the property anyway, so it was an absolute minor. And the property really was only purchased for about 15% less than its true market value at auction. And if you think, there was quite a few hurdles to still jump through, because we had to exchange very quickly. We had limited time to complete. We needed bridging. There were fees in the auction particulars. Not that much time to raise inquiries or do due diligence. It's just, you know, that's it. You've got to buy it. So that was the first one. But we made money out of it because we bought it less than you can just buy one in an estate agency window. And I'm sure there are better deals through estate agents that you could do as well. But that was just our first semi-detached house. We converted it into a 6-bed HMO. We did single-story rear extension, hip to gable loft conversion, and we let it to nurses, and we still have it in our portfolio. And it refinanced most of the money out, so it was a good one, really. But that's kind of the early days of doing auction stuff.
Early stuff.
Yeah.
And before we get into kind of what you're doing now, I guess as somebody who transacts very regularly in auctions, got different people that listen to this podcast at all different parts of their journey. You know, in terms of preparing yourself for buying an auction, what would you say you kind of need to do to get ready?
Okay. So since that first transaction and gaining knowledge along the way, so I've now gone and bought a number of properties, but I've also gone and started to sell some stuff at auction, and the mindsets are quite different. But what you soon establish when you divulge yourself and get into auctions and start to really understand this stuff is that auctions are not the place people think they are. There's a lot of stuff that goes on that people don't understand. So there are some auction houses in London where at least 50% of the properties being sold are actually being sold by auction traders who have exchanged contracts with a delayed completion, and they're back-to-backing property in auction. They're not paying stamp duty, and there's nothing wrong with that. But if you're a novice buyer who sees this property in auction that's too good to be true, you know, why is it guided at 200 grand less than it should be? And then you turn up to the viewing and there's 100 other people that want to view this property, you should be thinking, this doesn't look right, you know, because it's just an artificial process. All someone is doing is they probably don't even own the property yet. They've exchanged on it. They put it in the auction. They've guided it 100 grand less than they bought it for. And they're just hyping this thing up to get hundreds of people to go and view it so that it goes for a lot more money than they bought it for. And that is some auction houses, more than 50% of their stock is that exact scenario. It's the cash buying companies, the rapid fast buying traders. Some of them, unfortunately, have a very bad name in London because of their practices. You know, there's a few of them that at any one time they'll have in excess of 1,000 properties in their pipeline. And their practices are quite bad. They'll go and agree to buy 1,000 properties, delay the process of trying to buy them. And then as soon as they get through to exchange of contracts, they'll be trying to chip the price 10, 15%. Out of those 1,000 properties, 950 of them are going to say, bog off, I'll put it back on the market. But the other 50 to 100 are going to be desperate at that point because they've been strung along for 3 months. And so they do accept that 10% reduction, 15% reduction. And then on top of that, to make it even worse, they then find out their property's been put into an auction. So there's an underworld of auctions. These traders that are doing this, there are some really bad traders that do this activity. A lot of the time they are bidding on their own properties, a bit like eBay. If you put something up for sale on eBay, sometimes you're not supposed to do this, but you might ask a friend to bid you up a little bit. The same activities happen in auctions. And I know that because I've tried to sell some properties at auctions and I've been offered that by auctioneers. Would you like to bid on your own property, Omar? Because we know you do this stuff for a living. And it's always, no, I'd like to let it sell for what it's truly going to sell for. So, sorry, very long-winded answer. But for someone who's not bought auction before, there are a few things you really need to know. Everything that's sold at auction is sold as seen. There's a terminology called caveat emptor or buyer beware. Okay. If you buy something at auction and the hammer falls, that's it. There's no getting out of that contract. If you fail to complete, you will lose your deposit. You'll forfeit your deposit. You'll be sued potentially for something called detrimental loss. You can lose significant amounts of money. So you need to know what you're buying, and you need to have a survey. You need the solicitor to read the legal pack. You need to know, is it mortgageable? And you need to have plan A, plan B, plan C, plan D, just in case it all goes wrong. It's that dangerous.
I think definitely the time frames you talked about, understanding the time frames you operate in. I think it's very interesting you mentioned the percentage of properties that are being traded, because one thing that I've seen a few people fall foul to is not understanding that some lenders will have a requirement for the seller to be the registered owner of the property. And if you don't have the ability to complete cash, they'll simply say, well, we can't lend, but it will be in the conditions, generally the special conditions, that they don't have to be the seller and they're not going to supply any additional title information.
So imagine now you're buying a property. You don't know that the person who's selling it is not the actual seller, and they're a middle person making a slice of money in between. You shouldn't really be trying to get a mortgage on an auction purchase. You should have mortgage, cash, and bridging all lined up as whichever one comes through quicker. But let's say you do try and get a mortgage, you find out you can't. You're then relying on other means to try and finance it. If you can't raise the money, you're just going to forfeit your 10% deposit. And for some people, that's a lot of money.
Most people, that's a lot of money. I mean, it doesn't really, I guess, depend on the type of property you're buying, but it's always relative, isn't it? So
it's a bit of a business model from some of these traders, actually, that they don't mind it if you forfeit your deposit.
And that's why you'll see sometimes the special conditions are only updated, a couple of days before the auctions.
Loads of bad practice. The other thing you get as well, I'm not sure if you've seen it, but the seller will put in large fees in the auction legal pack in the special conditions, and it will be written out in words
rather. So they might say a £650, in numbers, and then and they'll write out that you also pay 2%,
or 2.75% plus VAT.
Exactly, but write that out in words. I think you do have to be very careful, which is why I always say, look, having the right people in place that know their stuff. So we've been in property for however long. There's still a lot of times where I'll skim a legal pack, but if I'm really serious, I need to get that independently reviewed
in the zone.
But even that, it's like sometimes there's 20 documents. Some of those documents are 50 pages long, and so I missed something the other day, which was I read a report from the management company, and I read it as, okay, so there was like, £250 of outstanding ground rent. I thought, well, that's okay, that's fine, that's the only outstanding money. But the management company didn't collect the service charges. So then, luckily they weren't that high, but it was a service charge arrears of like £4,000 that hadn't taken into account, which is still a significant sum of money and is going to have an impact on your return on investment. So I think, you know, getting them reviewed independently. The other thing I wanted to touch on when you mentioned about the people trading is that, I don't know if you've seen this practice as much, but outside of even exchanging on a property, now sometimes people are putting a property in auction, you know, without even exchanging, with maybe an assignable contract. And so they'll have a clause in place that says we can either choose to exchange or you pay us the difference and you exchange and you basically complete with the vendor. And
that's known as the have your cake and eat it clause.
Exactly.
Which is like, if I make money, I will sell it to you. But if you're not paying me the right amount of money, I'll change my mind and I won't sell it to you. Auctions are supposed to be an arm's length transaction. If the hammer goes down, you're expecting the ability to buy that property. But if you imagine now, one of us as an investor, we're thinking, yeah, I've just won that property at a really good price. But if that clause is in the legals, they potentially can change their mind and not sell it to you. So that's really difficult. I think what I do when I look to buy something at auction is the first thing I always try to establish is who is the seller and are they a trader? Because if I know they're a trader, and there are easy ways of establishing that. Typically you'll find in the transfer documents, you'll find that the seller's name is redacted. So it will be blacked out. They do that on lots of ones, but that's the first hint. Then you're looking for large fees in the special conditions. Then you're looking at the lot number. If the lot number is very low, most auctioneers will give traders the preferential lots at the beginning. They don't put them at the back with all the Hartlepool stock that no one wants to buy. You've also...
Sorry if you're from Hartlepool, by the way.
Yeah, nothing wrong with Hartlepool, but there tend to be a lot of Teesside and Hartlepool properties that are always at the back of the catalogue. So you'll have preferential lot numbers, like you said, legal documents coming in right at the last minute and all these things. And also just the auction house. There are some auction houses that don't really deal with traders, and they are typically good ones to buy from. And then you've got some others in London that have now got terrible reputations of almost being run by traders. So it's like, which one do you want to buy from? And being cautious of who you're actually dealing with.
But we don't say that to put you off auctions, because both of us are still actively buying in auctions. But I think the thing about property is you can make a lot of money in it. It's very expensive, but mistakes are equally expensive. And so it's very important, which segues me onto a really good point, that you've actually, coming up very soon, have like an auction workshop coming up soon, right?
Yeah, so I mean, there's a bit of a YouTube thing that's going on where we do speak about auctions. We do some sort of, I'm not really an educator, to be honest with you, because I'm more running my own businesses, but I do like sharing information that I think is going to help people. So we've got a commercial property workshop that's coming up, which is all about commercial property. And then later on in the year, there'll be some more auction stuff that's on there. But you can find this stuff online. We've done loads of videos and things in the past as well.
Well, so, definitely. I'm gonna press you for some links afterwards. We're gonna make sure we put them in the description.
Cheers,
so you can go and check
so
all of those out. So we spoke about some of the bad parts of auction. Let's talk about some of the good parts. So you're still actively buying. What type of properties are you buying, and what type of returns do you hope to make from these properties?
So over time, I've tried to typically the way I've made money in auctions is actually buying stuff off market or through estate agents and actually selling it in auction. That's one of the biggest strategies I've been following over the last 3-4 years. So auction trading, but not done through other people's misfortune, which is what some unscrupulous traders will do. So I don't typically focus on the 3 Ds, the death, divorce, and debt. I'm not looking for people that are highly desperate to sell their properties. I mainly look for properties that have something that someone's missed. So if you look through my Instagram page, I've put quite a few of my auction trades on there, but they typically are houses with plots of lands to the side that I've exchanged on, put planning, got planning granted, and then sold it off just for a quick trade to move on to another project, or a commercial building that has been bought as a whole, but it has multiple buyers, that potentially someone who wants to buy the commercial as a S.I.P or a S.A.S investment, someone else who wants to buy the office bit.
Give us the difference. Give us the S.I.P and S.A.S breakdown.
A self-invested pension pot, or a S.A.S is a self-administered scheme of a pension scheme. So there are some people that love to buy a commercial property and hold it in their pensions because it's very tax efficient. But my point here is, there are different pools of buyers. You've got homeowners that buy at auction, you've got developers, you've got buy-to-let landlords, you've got HMO investors, you've got commercial property investors. And sometimes it's about finding something that has all of that, but then breaking it up into the little bits that are suited to those individual people. So for example, I bought a commercial property in Lewisham, and it had a shop on the ground floor, an office which hadn't been converted to resi, 2 flats which had been converted to resi. The loft space had been illegally converted without permission of the freeholder. And then in the rear, it had a dilapidated old barn. Now, the buyer who wanted to buy that, there's a limited number of buyers that wanted to buy this whole thing. But so what I did was I took control of this asset, I exchanged on it, and then I broke it up. So I sold off the shop at auction, and a lady who put it in her pension bought it at auction. I sold off the office space, and someone converted that into a 1-bed flat. And that was great for a little, not a newbie developer, but someone who wanted to take on a small project.
Yeah, something they can do under PD, not too stressful.
That's it.
And, you can make a reasonable term, but you can mitigate your risk.
And made a bit of money out of doing it. There was something in it for all these people that took it off me. And then at the back, a barn, we put planning in for a bungalow that got granted. Someone bought the bungalow and did a small scale property development there. So it's kind of, I look for title splitting opportunities, badly described properties, misdescriptions, a residential agent trying to sell a commercial property and has got it completely wrong.
Like that's where it's why I always say, like, a lot of the money in property is in the opportunity that other people have missed.
Correct.
Or using your experience to problem solve. So you could have a number of issues on title that can be resolved, but they're going to take a little bit of time. Or like you said, somewhere where people think there's structural issues that again, the solution and therefore it's less risky to you. And you also know that it can be solved with, more cost effectively. Yeah.
So it's an interesting one, because I think whenever there's a red flag on a property, some people, their immediate reaction is the mindset of scarcity, and they kind of back off and think, oh no, it's Japanese knotweed. I'm too scared, and I don't know why my mindset, that doesn't seem to happen to me. Maybe I'm a bit crazy.
I think it's not, I think it's the job of an entrepreneur. So your job as an entrepreneur is to look at things and work out how you can make it work as opposed to why it won't work. And I think, so when you look at entrepreneurs, that tends to be a common denominator, that they're problem solvers rather than just problem finders. Yeah.
And an interesting fact, actually, I heard that the second sibling is always more entrepreneurial than the first one. And I'm a second of 2 children. Too. I'm not sure if you are.
But me too.
I heard that. I'm not sure why that is. But so, for example, I've bought a piece of land with knotweed and have tackled it as a solution. I've bought...
so go on, let's hear you.
You want to hear about knotweed now?
Give me your top three sort of problems you solved.
Okay,
you said,
so
interesting.
Okay, so knotweed. I bought a property at Clive Empson. Sorry, it's not a property. It's 14 garages at Clive Empson auction, and it had, in my view, been badly described as garages for sale, and there was lapsed planning from years prior that wasn't really marketed to make it look like actually this is a development site. And although people just needed to do some digging, they would have found that. But this site had knotweed on the boundary with the neighbour. And all of the people that were going there to view were thinking, bloody hell, Japanese knotweed, how is that going to affect the development? What are we going to do? And there's a lot of common misconceptions about knotweed, that it will ruin everything. And yes, it can grow through the floor, and it is an invasive plant and is a little bit annoying to have it on your site. But all these problems can be solved. So, instead of paying a company to come and spray the knotweed and take loads of money from me over the next 5 years, we just got a very large excavator, a 14-ton long reach excavator. And we just dug a hole 2.5 meters down into the ground. And we just got rid of the infected soil, and we removed the knotweed, and we got a 10-year backed insurance policy, and it's completely cured.
So I think it's just all about solutions.
Yeah, it cost 15 grand and job's done. And now the site is free from knotweed, and it's completely mortgageable. And
I'm sure you got some happy neighbours as well.
Yeah, and the neighbour's very happy. So that was one. Structural problems, a lot of them, in my view, are not really structural problems. I've been to some properties where you can put your whole arm into a crack. I'm sure you've been to them.
Yeah.
I stay away from them most of the time. But
even those, I feel like a lot, like if you know the issue, like, so a lot of Victorian properties, clay pipes, it's just the case that the drains have cracked. And so you've got water just seeping into the foundations. And as long as you know where the issue comes from,
I agree.
and you can attribute a cost to the solution. I think it's where the solution's unknown, you're then taking a bit too much of a risk sometimes, because it might just be a case of underpinning by half a meter. They might say that, well, actually, this thing basically needs to be knocked down and rebuilt.
Yeah, so Kaz, that doesn't put me off now.
Yeah.
I look at structural problems and I just think, what's the solution? You know, there are ways of injecting the ground with resin, and you don't even need to underpin on some of these properties. But so I've done some structural stuff. Right now, interestingly, I'm just in the process of acquiring 2 houses, semi-detached houses that are together in Dartford. And it's been marketed terribly. You've got 2 different agents, one marketing each of them. And on the description, they've put non-standard construction, not mortgageable on the description, right? Now, obviously, I'm background in mortgages for 10 years. I've just gone and bought the title deeds for about 20 properties that are really close to this one, and they're all made of the same construction. It's a particular construction called wimpy no fines, which is a type of concrete, prefab concrete. But there's some really bad concrete, and then there's some that's not that bad. And this is one of the ones that's not that bad, but the estate agent has marketed it as in cash buyer only.
Yeah.
So, but just doing some research and seeing all these local properties are mortgageable, you've just got a reduced pool of lenders that will lend on wimpy no fines, and we've solved the problem. So,
and then effectively, it's just a case of then when you're going back to market, or if you were going back to open market, you're just saying, look, more than happy for you to, but you're going to have to use our broker, because then you know that they're gonna obviously give them options.
We don't do that because I tell you why we don't do that, because it's almost seen as a bit of a conflict of interest. But
not even for you, but I mean even maybe the agent to use a broker, they have a relationship externally with.
What I actually would do one step further than that is there's a piece of software called Criteria Brain, and I can just type in wimpy no fines and it gives me 25 lenders that lend on it. I just download that report, send it to the estate agent saying, can you make sure they use one of these lenders? So
there you go.
Other problem properties, I bought something in Orpington 2.5 years ago, and it had spray foam insulation in the loft. I'm not sure if you've come across this yet. But,
no, but I haven't. But whenever I've seen it on social media, like they use it a lot in America, it looks really fun.
Yeah, it does look quite fun, doesn't it?
It's fun to install it.
Yeah, fun to install it. Not so fun to get rid of it. I can give you some stories about that. But so no, I got sent this property by an agent. They said, we've got something we think you might be interested in. I'm kind of known as that guy who solves problems a little bit. And this, the sellers had been recommended by a company. There's nothing wrong with spray foam, but I think there's some bad types and some good types. And the lenders haven't really got to grasp with which is good and which is bad. So at the moment, there's this kind of blanket ban.
So a surveyor sees it and just says, no, it's got that.
It's got spray foam. We don't want to lend on it, which is incredible, really. But because some of it is combustible and they're worried about fire risk and this sort of thing. So anyway, long story cut short, the seller had 3 or 4 collapsed sales because people kept struggling to get mortgages. I got the phone call, said they're really motivated. Do you want to do it? And it was as simple as buying the property and scraping off the spray foam, and it's completely mortgageable. It took 2 days and some manual labour. So really, really simple process, but opened up a really good asset that had a building plot on the side, which was the other motivation to buy it, really. So anything that's got a problem that can be solved, as long as the question I ask myself with risk, because I obviously I'm prepared to take risk, but not to the point where I'm going to lose the shirt on my back, is I typically will say, what's the worst thing that could happen? And am I prepared to accept that? So if it's a case of I break even or I lose 30, 40 grand, am I going to lose the shirt on my back? And I kind of do that first. And then if I say, well, what's the upside? The upside is you get planning, you get a building plot, you get rid of the spray foam, it values up, you sell it on, you make a good profit. Then most of the time, I'm willing to take the risk.
I think it's just, when it comes to risk, it's just understanding your own risk tolerance, because some people's risk tolerance is only dialed into I'm willing to break even or lose a couple of thousand, whereas some people's is like, I'd rather do a deal where I maybe lose 30, potentially make 200. Some people would rather do a deal where worst case I break even, best case I make 50. But I think understanding where you sit in risk tolerance is a really...
Do you think that is something that we learn from childhood, or do you think that is something that we develop? The level of risk you're willing to take on property deals?
I think it sometimes you learn through experience. I think if you get burnt once early on, then you know, you can say, look, I'm just not doing that again.
Yeah.
But saying that, I've got friends who are geared to the max at risk. Like they're literally if you give an option to flip a coin for life savings, they're thinking chance to double up, no brainer. So
it's incredible,
I think
isn't it?
there's some people that are dialed in that way, and either way, like I respect either preference. You know, I just think what I do say is just do whatever works for you, and I think that goes for business as a whole. You haven't got to look at if somebody else makes a load of money doing something, it doesn't mean that's the right angle for you, because it might be their skill set, might be their risk tolerance, might be an abundance of other things.
I think you're right. It's a weird one, because if I go back like a couple of generations, so my family originally from northern Cyprus, so a Turkish Cypriot, and my granddad, who immigrated to the UK and set up some dry cleaning businesses, he was very risk averse, and you know, got his residential home, and that's it. You know, don't borrow, don't credit card, don't loan, don't take debts, pay your mortgage down. That was the kind of mindset back then. But I sort of wondered whether he had this entrepreneurial spirit to take businesses on, which are risky inherently, but didn't want to take any assets on. And I just wonder whether it's because of a lack of education for him, or more of...
I think that's definitely generational. The concept of debt is bad is definitely, I would say, like our parents / grandparents, more so generation, that it was grandparents taught that it's bad. Parents inherited the debt is bad mindset, but was slowly starting to adapt. And I think where we have an abundance of different learning news sources now, that I feel like we're adapting even more so. And I think when we look at the people younger than ourselves, like the Gen Zs, their attitude is, I'm only going to work if it's a work from home. I don't even want to go to work, you know. So I think it's going to move even more so. And I think, you know, when I look at some things that some of the younger guys that I work with and girls that they're doing it, like, you know, the youngest person in my sort of community is 20, and he's bought his first home at 19. Wow.
It's incredible.
Like, you know, he's just made it happen. He's made it happen from being self-employed. Which the idea of buying, you know, a buy-to-let property, you know, as a 19-year-old whilst being self-employed is like mind-blowing to me.
Incredible, isn't it? That he's willing to do that. Yeah, amazing. Yeah, so that's kind of the journey really of buying and selling properties at auction, is just really looking for missed opportunities. I'm not looking for people that are desperate to sell. Not that isn't a marketplace. It's just not something I've kind of gone after. So it's more finding problems and then...
So we've touched on obviously your background in terms of your primary business, then obviously the auction trading. In terms of where you are in your own personal journey with the properties, that are you focusing on holding at the moment, flipping? Like, what's your strategy when it comes to your own portfolio?
So Trinity, it took a long time to build. It wasn't something that just happened overnight. It was gradually taking on 3 to 5 advisors a year, teaching them. And so I'm still heavily involved in not so much micromanagement, but overview, oversight, top team level meetings, you know, and that there's still a lot of involvement, that you get calls on things and you think someone else could be dealing with this, but it's part of running the business. So that's kind of, I've tried to focus on giving less and less of my time there, not because I don't value the business, I absolutely do, but because of the enjoyment that I get out of it over time. So the passion has been trying to build the property portfolio, and what I've realized is that large chunks of money can be made in flipping and trading. And so I've been actively trading and flipping to build the portfolio. I only hold property in Southeast London and Kent, and I predominantly am trying to hold luxury HMO. So this is 15 square meter rooms with small tea stations in the rooms and luxury en suites.
Question about the tea stations.
Yes.
Lender's opinion on tea stations.
A lot of them don't like it.
Can you give us some that do like it?
I can do. Yeah, absolutely. There's a number of them that do like it, and what you'll find is it's more of the commercial type buy-to-let lender that's got appetite for it. The key thing really is, I mean, it depends borough to borough, because if you're looking at HMO licensing, when someone is cooking in their bedroom, if they're sleeping, washing and cooking in their bedroom, it's completely self-contained. If a tea station essentially is a place where you can make tea and store food, but there are no cooking facilities in their bedroom. So we still put communal kitchens that meets the HMO licensing requirements. And so what we're doing is we're creating luxury rooms that people can feel really comfortable in. And if they want to make a cup of tea late at night and they're in their pajamas, they haven't got to go out to the kitchen. If they want to store their own food and someone's not going to nick their milk from the fridge, all the stuff you get in
University,
HMOs.
not getting nicked out as a pandemic in
Yeah.
itself.
So what we've essentially been able to do is charge more rent because it's a luxury product. You know, we give them televisions and all that sort of stuff. But then at the same time, not go completely self-contained, which has a whole host of soundproofing requirements and all the rest of it that's involved in those types of conversions. So
with those, do you know any of the lenders that are happy
it's a few of them that do it. So the biggest one at the moment, which is quite a big lender for commercial lending, is Shawbrook Bank.
Okay, yeah.
So they're quite up for it. You do need to meet requirements and stuff, but
I think they do a couple of my HMOs.
It's really good.
They're good, to be fair. There.
And with Shawbrook as well, I'm plugging you, Shawbrook. So if you're listening, get in touch with Kazy and sponsor the podcast because he's looking for sponsors. But Shawbrook Bank, they do hybrid valuations on certain asset classes, whereby depending on the location, sometimes it works, sometimes it doesn't. But if you've got a lower value area and you're getting a large amount of rent because you've adapted the property a lot, it does depend if you've changed the use class from C4 to sui generis and some other complexities, but you may be able to get a much larger valuation, valuing it as a commercial property rather than a residential one. And Shawbrook are very good at that.
Yeah,
so,
no, they are. They've been good. Okay.
So the question was, what am I doing? I'm trying to hold high. I don't really hold many low yielding properties in London.
It's a really interesting conversation that a lot of people don't necessarily understand, particularly, you know, if maybe where they've learnt their strategies from are people that are doing BRRR outside of London, in that the goal is to just keep everything regardless of the type. But if you're, for example, doing like myself, a focus on either, you know, flat reconfigurations or residential to residential conversions, it's amazing to turn a 4-bedroom house bought for £500,000-600,000 into 4 luxury self-contained units. The issue is that those units off the back end that are now worth 1.6 million at a 75% loan to value, you've still got whether or not it's your own money or if it's, you know, your profit in equity, £400,000 that's maybe making you £400 per unit isn't a good return on investment.
Yeah, I can see that. I suppose it depends on how much money you're leaving in these deals, doesn't it?
But for me though, it's even if you're leaving in none of your own money,
you would prefer to use that elsewhere.
To have that money. So I have this thing of wealth creation versus wealth preservation mode. I think at the point in time where I want to relax and be on a beach somewhere in Jamaica or Bali, then, you know, I just want passive buy to let. But at the point where I'm saying I'm still happy to work for my money effectively, I feel that making, you know, 4% versus maybe, like you said, if you have the capital to flip properties at auction and you're making 35%, I'd rather be more active at that.
I think that's a really good point. I think with HMOs, because a lot of people will say, why are you doing HMOs? Aren't they really like a logistical headache? And who's managing them and this and that? So my HMOs are London, Southeast London and Kent. And there's this common misconception that every HMO is filled with a drug addict, asylum seeker, or someone who's come out of prison. And there are some HMOs that are perfectly suited for those. And there's nothing wrong with the people that do those particular properties. But my focus area is affluent areas where there is a large demand for rooms. And I run test adverts in the areas, and you typically put one room up, you get 100 inquiries.
It's the room rental market at the moment.
So it's not, in my view, there is a little bit more headache, but if I can take a house and turn it into a 6-bed HMO and it can produce £1,000 a room, that's 72 grand a year. You can't get that in a standard buy to let.
No, definitely.
So that's the reason I do it, is to get cash flow.
And I think for those that you mentioned are confused about the tenant type, when you look at average salaries for a trainee doctor, starting salary for a police officer, a nurse, an accountant, like they're generally within a bracket where, yes, they could afford a 1-bedroom flat. However, they would be working they basically just working to live. You know, so I think a lot of people would much rather be in, you know, depending on their stage of their career, in a space where they sacrifice some of the rent to have really nice facilities, really nice space, nice, you know, communal space, and then just their own home, even though it's a room. So I think it works really
home
well.
within a home. It's a tricky one, because I think that there is that negative connotation, but once you kind of break those barriers down, when we submit some of the HMOs, we've got a sui generis large ones, and when you go to full planning, we actually put in our planning application the type of tenants that we let to. We put pictures of the previous projects so they can see what we're actually going to create. It's quite nice.
I think, and even you mentioned areas, but like So during like pre HS2 and things like that, was buying in sort of Greenwich
You
and
were.
Plumstead.
Oh, right. Yeah.
And that was pre Article 4
Okay.
there as well.
Yeah.
So we're buying there. And it wasn't, an affluent area
Yeah.
by any stretch, but it's still London, not that far from the
Yeah.
river. And when we looked at, someone said, "Oh, who are your tenants?" It's like, okay, well, we got a nurse, a police officer,
Yeah.
someone that's in film and production,
Yeah.
and somebody who's, they're a CEO in a charity and they're just saving for their own home.
Yeah.
And it's always really nice when you see the journey of some tenants who would stay with you for 3 years. And then when you ask, "Oh, why are you leaving?" It's like, "Oh, I just had an offer accepted on my own home."
Yeah.
Which is lovely to see.
I've seen that exact scenario actually. So, sometimes the type of people that come in, I look at their salary and think, you're earning 80 grand. Why do you want to rent this room
sometimes
from
I
me?
look at that and I just say, but then, like you said, it's
a stepping stone, and you hit the nail on the head. The 1-bed flat's got the council tax, the gas, electric, water, the bills, and before you know it, you're spending 1,500, 2 grand a month, and they can get the room. They're happy there. So there's definitely a need for it, and I think that's going to keep growing. The problem that we have, the big problem, is the Article 4 that is spreading like a wildfire.
And I think outside of Article 4, I think one thing that a lot of developers are not that abreast with is understanding the difference between Article 4, understanding selective licensing, the importance of licensing, like a licensed property versus changing to C4 versus sui generis. And I think those intricacies are really important to understanding actually how viable your investment is. Because, for example, in Greenwich, although... So I was buying pre-article 4, which meant we just had licenses. There are some lenders who will say, well, even though it was historic and you've got established use, we still want you to go down the full planning route to get a significant amount of uplift.
Yeah, it's a challenging one. So, I mean, one thing that I've always done, I've told every single client that I've ever arranged a HMO mortgage for, as well as my own, is that even if you're converting from C3 to C4 under permitted development and it's a non-Article 4 area, so you're within your rights to do it, I always tell them to go for a certificate of lawfulness. And you need an architect to draw a floor plan and you need to pay a fee to the council. But once you get that paper, it's rubber stamped. It can't be taken away from you. And so, I've got some HMOs in Bromley, the borough of Bromley in Kent, not Bromley by Bow. And who'd have thought a conservative borough that had hardly any HMOs in the area at all, they implemented an Article 4 directive in the whole of Bromley Borough, even though it's not saturated with HMOs. So all my HMOs that I did, which were C3 to C4, I had certificate of lawfulness. So I didn't need to go back to the council and say, oh, by the way, I've had this HMO like this for 5 years, but I just didn't tell you about it. Can you come and check it? Because you're kind of then asking for permission. So I know on every HMO application, I notify them up front. I just say, just so you know, we're converting this to C4. And then they know, and it's rubber stamps, and it doesn't cause me a problem with lending. So rather than this grandfather rights, and it just becomes really, really problematic, I think. So
like anything, if you can cover yourself, sometimes it's pay to play. Spend a little bit of money now to save yourself a big headache later.
Yeah, it's very good.
Final question for you.
Yes.
We're in recession.
Yeah.
Apparently.
Yeah.
How are you finding that? What are your thoughts on market ahead or market at the moment and where it's heading?
So they're saying we're in a technical recession. I feel, I mean, a lot of the data that gets released is historic in my view.
I think am I right in saying it was 0.3 the quarter just gone and 0.1.
Yeah, so two negative quarters to have a technical recession. But when you look at the data, a lot of the data there's a massive lag. For example, land registry. The land registry keep releasing this data, but it's on transactions that happened 6 months ago. So it's kind of like, how do you predict exactly what's happening? But from the front line of property investment, I don't know what you're seeing, but I saw a period of time where demand was very subdued and actually supply was constrained as well. That a lot of people just said, oh, I won't move now. I'm not going to sell now. So there was no supply, but the demand dropped. And so it kind of was just a bit flat for a while. And then now I'm seeing rates have come down a little bit, and all of a sudden people have sort of, I'm going to buy something now, I'm going to move, or so there's more activities, a lot more properties coming to the market. But that period of time that we had where everything was going over asking price is definitely gone. I think people are buying a bit under. Some people are paying asking price if it's a really good property. But I think there's still a really good opportunity. You know, people say money's made in recessions.
They say the most millionaires are made in recessions. So I think regardless of the market, there's a lot of opportunity. I'm just interested to see your, because I think particularly because the data does have such a lag, auctions are often quite a good indicator of where we're at, because it's very present. And that January, I think I shortlisted 12 lots, 1-0. They all probably went about anywhere from 5 to 10% over what like I would have paid for them.
So are you using any software for looking at auctions, or are you looking at the catalogs directly? Or
no, I generally just look at the catalogs directly.
So there's a piece of software called Essential Information Group. It's kind of it's a very large bit of software actually, but not that many people know about it. Again, Essential Information Group, if you want to get in touch with Kazy.
I just use them just to check what auctions are coming up.
Okay,
so I use the,
so you'll be able to go in, but there is actually a paid membership that they have, and what it does allow you to do is, so you can set alerts. So for example, I have the software, and any property in my patch that is being sold, I'll get a notification as soon as it's been listed, and I can set criteria. I can change the filters. If there's a property in Manchester, if there's an auction house in Manchester that's selling a property in Kent, I can say, I want to know about all auctions that are not in London that are selling a London property.
Because that's where you hit your niche of maybe a non-fit for purpose seller, bad description, not going to have the demand for it.
Lots of filters. And then if I see a property that goes to auction and I want to know some history on it, I can put the address in and it will tell me all the history if it's ever been to auction before. So there are lots of properties that you don't realise. You're looking at it and you've seen it on Rightmove and you think, oh, that's good. But you don't realise it's been to Allsop, Savills, Clive Empson.
That's often a
massive red flag
when you've seen stuff.
So great bit of software. It's called EIG. It's paid for software, but it's very, very good. I use that a lot.
Yes, I think there's definitely, we talk about like generational people that are now growing up in AI and a lot of tech. I think there's an amazing opportunity. If you grow up in that space and live, eat, breathe AI, I think it doesn't matter the field, you're going to excel, because the stuff that I see that, you know, people are doing. And so I was speaking to a guy, he's 23 and he's built out this software that basically does automatic comparables. Using AI. So the AI will scan Rightmove and it will be able to say, yep, this property is Victorian, scan all the words and be able to say, yep, this is a sort of 90% match based on square footage, scanning things.
Is that property data or something different?
So it's something, I think they have like an API that goes into something similar to property data, land reg, and also Rightmove. But like he gave me an example of it, and he just uses it in-house for his own purchases. Wow. But I was like,
that's very good.
I was speaking to him, I was like, are you selling this?
I
can market it. Is there business to be done in? Because it was amazing. But I definitely think.
So we spoke about the lag in land registry. Auctions are they are the heartbeat of the property market. If you want to know what's happening in the residential, commercial house prices, if you look at the auctions, because of the nature of the auction being such sharp timescales of you exchanging on the day and you complete within 4 weeks or 28 days, that shows exactly what's happening. And I think it depends which auction house. Some have done phenomenally well. Others have really struggled. Then you've got the seasonal thing. Sometimes December doesn't perform that well, and then January does because everyone's thinking about Christmas. And and then in January everyone wants to get on. Actually, there's not many auctions in January. They all kick off in February.
February is always super busy.
Yeah,
February's I think. Savills are twice this month. They're SIP fan the 27th, and then I think on the 14th you had, which was strange. You had like, I think it was Allsop's Auction House London, and
loads all on the same day,
and McHugh's all on the same day.
And massive catalogues. You know, if you went back before,
it was 100 and something units. Now you're looking 300 plus across 2 days.
So I had that weird thing of buying properties in the room in an auction house, of bidding and looking around and seeing who else is bidding against me. And you know, the adrenaline of being in the room.
I miss the room.
Do you really?
Do you not miss the room?
I do, in the sense that I feel like you probably got better deals in the room because there's not that many eyes. You know, people had to travel, and you still people bought well in the auction in the room, and maybe some properties sold for even more than they should have. But online, I think there's just so much competition because anyone can do it.
Because sometimes you bid
Click a
and before
button.
you went to bid and you've bid like maybe 2 bid points ahead of you wanted to, because it's just gone.
Yeah. So I've got my own way of doing it. But if I want to buy something now, I just literally either do a proxy,
Just do your proxy
or
and
I
just
set
say,
the bid and I just set and forget and leave it. It's the one.
Take the emotion out of it.
It's the people that are on the mouse and they don't realize the auctioneer can actually see where you're moving your mouse, believe it or not. So if you're hovering over the click button,
oh wow,
they can see.
They'll do that. Go. They'll give you an extra little time. They'll see
say,
that you're close.
Mr. C, we can see you're hovering over the click. Please just push down.
What? I've heard that before, but I've never realized that actually this is the figure, the information age. Everything is out there. Everything is transparent.
So online they see it all, but in the room, you know, they didn't know. I used to do some strange stuff in the room. I would sort of be bidding on a property and I'd make a bid, because what the auctioneer wants, this is the philosophy of an auction, the psychology of an auctioneer, they want their bidders to bid fast and quick, and they want to bid you up fast, you know, 220, 222, 224. They want that.
They don't want the time to think.
They don't want any time, right? So the way to disturb that in the room was you bid your amount and then just look down at your phone and walk out the room if you want to, come back in, you know, just completely mess up their psychology and their cycle. Or if they're asking for 220 and you know this property is going for 300, you bid 10 grand more. And everyone else in the room's looking, thinking, why is he doing that? Yeah. So we would do some crazy stuff in the room. Online, it's a bit more. It's a bit more tricky, but there's still options.
But that's what I mean. There's a bit of fun.
Yeah,
like, it's like in the room was almost like a bit of poker.
Yeah,
you know, you had a little bit of mind games. You felt like you could influence a little bit more. Whereas it's sort of. But no, it's been interesting. It's been really good.
Good chatting to you.
It's always good. So just before we sign off, can people let people know where they can find you if they want to connect with you?
So my Instagram is Ohms Under the Hammer, so OMZ, if you want to follow me there. I'm on LinkedIn and Facebook and all the rest of the stuff like that. Or you can look up the main business, which is trinityfinance.co.uk, and you'll get my email address on the website, or I'm sure Kazy can put it in the notes if anyone wants to get in touch.
Amazing. Well, thank you very much for joining us. This has been another episode of the Property by Kazy podcast. I definitely recommend connecting with Omer. Amazing at what he does. Check out the event on the 20th.
So there's a couple of coming up. I'll put them in the group, but you've got one which is on the 5th of April.
5th of April.
Yeah, that's a commercial property workshop. And then there's some other stuff which is online. So I'll share the details.
Send those all over to me. We'll make sure that so everyone can connect. If you haven't already, make sure you subscribe. If you've got any questions, you can use the comments. Like this video, and we'll catch you next week for another episode.